You saw the headline and probably scrolled past it. Another trade agreement, another diplomatic press release, another technical announcement that felt distant and irrelevant. But history rarely announces itself with explosions. Sometimes it whispers through documents, hides behind optimistic language, and passes unnoticed until it becomes irreversible. What just happened between the European Union and India is not a routine trade deal. It is a structural break, a quiet decision by two massive economic actors to re-engineer how global trade itself works. By the time most Americans feel its consequences, the system that protected them for generations will already be weaker. This story isn't about politics or ideology. It's about power, and how power slips away, not with a bang, but with paperwork. The public version is straightforward. The EU and India announced a landmark trade partnership worth roughly $890 billion over the next decade, focused on clean energy, digital infrastructure, pharmaceuticals, and expanded market access. On the surface, it sounds like progress, green growth, modernization, efficiency. Nothing threatening, nothing dramatic. But that narrative omits the single detail that actually matters. This deal is designed to function without the US dollar, not symbolically, not as a contingency, but structurally. The dollar is optional, not foundational, and that design choice changes everything. For decades, Americans were taught that the dollar dominated because it was strong, trusted, and efficient. That explanation is incomplete. The dollar became the operating system of global trade. Oil priced in dollars, shipping insured in dollars, debt issued in dollars, settlements cleared through dollar-based banks. To trade globally meant passing through the U.S. financial system. This granted the United States unprecedented power, the ability to enforce influence without soldiers, using assets freezes, transaction blocks, and banking access as leverage. It wasn't abuse, it was structural, and for a long time, everyone accepted the rules, until they didn't. The break wasn't ideological, it was practical. After 2008, the global financial system revealed itself as fragile and politicized rather than neutral. Sanctions expanded, extraterritorial enforcement intensified, and European companies found themselves punished for decisions made in Washington, not because Europe was an adversary, but because dependency creates vulnerability. Then came the financial nuclear option, frozen sovereign reserves and countries disconnected from SWIFT. Money became a weapon openly. Policymakers everywhere reached the same conclusion. If this system can be used against others today, it can be used against us tomorrow. The response wasn't panic, it was planning. Europe thinks in timelines, not headlines. Over years, its leaders watched sanctions hurt European firms more than American ones. Supply chains become hostages to U.S. political cycles, and legal risk migrate from Brussels to Washington. The message was subtle but unmistakable. Europe was economically sovereign until it wasn't. When trust erodes, rational systems seek redundancy. Europe began doing exactly that.
India required no persuasion. Its foreign policy is built on optionality, trading with the US, Russia, China, and rivals simultaneously, aligning where it benefits and buying where it's cheapest. India understands that dependence is weakness. So when the EU proposed a trade structure based on euros, rupees, and direct digital settlement, India didn't see danger. It saw leverage, strategic, not ideological. This agreement isn't just about currency choice, it's about replacing infrastructure. It includes a digital settlement platform that clears transactions directly between Europe and India without New York correspondent banks, dollar conversion, or SWIFT dependency. Transactions settle near real time, conversions occur internally, and oversight remains within the system. It is a private economic highway, efficient, fast, and expandable. And once infrastructure exists, usage follows. The common American mistake is viewing this as political. It isn't. It's economic evolution. If a German firm can buy Indian pharmaceuticals faster, cheaper, and with less regulatory exposure outside the dollar system, it will. If that model scales to ASEAN, African manufacturing, or Middle Eastern energy exporters, the question stops being, why leave the dollar? And becomes, why stay? The dollar won't collapse overnight. Reserve currencies don't die suddenly. They erode gradually and structurally. Reduced global demand for dollars means higher import costs, persistent inflation pressure, and a diminished ability to finance deficits cheaply. This isn't partisan, it's arithmetic. For decades, the US spent more because the world absorbed its currency. If the world needs fewer dollars, the cost shifts inward, hitting workers first, communities second, and capital last. Here's the irony. Every time the US weaponizes financial dominance, it accelerates the creation of alternatives. Power used without restraint invites resistance, not through war, but through architecture. Quiet agreements, new rails, parallel systems. The EU-India deal isn't rebellion, it's insurance. Zoom out, and the pattern is unmistakable. China settles energy in non-dollar terms. Russia builds parallel payment networks. Saudi Arabia explores alternatives. BRICS experiments with new frameworks. Each move alone is manageable. Together, they are transformational. The global system isn't collapsing. It's diversifying away from a single point of control. No, not with threats, sanctions, or pressure. Those tools only work when everyone needs access to the system you control. The only real solution is rebuilding trust and making participation voluntary again. That requires consistency, restraint, and long-term thinking, qualities in short supply. This isn't meant to scare you. It's meant to prepare you. Understanding structural shifts early is an advantage. What follows will shape inflation, savings, debt, and the global balance of economic power. Once these changes are obvious, adaptation becomes harder. The EU-India deal isn't the cause, it's the symptom. The assumptions holding the post-war financial order together are gone, and what replaces them is still being written. The real question is whether this is adaptation or the beginning of decline. Share this with someone who needs context, not outrage. You're early, and in moments like this, being early matters.